Welcome to a new quarterly series from RiskWire, where we'll take a data-driven look at the U.S. housing market and share our latest Vero forecast home price outlook. We'll examine the economic factors shaping the outlook, including mortgage rates, inflation, and unemployment. So in this first edition, we'll look at the forecast for home prices nationally and across several major U.S. housing markets through June 2027. So let's get started. National home prices remain elevated, but appreciation is slowing. Mortgage rates remain high, and affordability continues to challenge buyers. And housing conditions are diverging from one market to another. So let's start with home prices. As this chart shows, the monthly house price index is a 2.5% year-over-year appreciation nationwide in June 2026 from the previous year. The important story here is the slowing of appreciation. Higher mortgage rates continue to constrain purchasing power. The average 30-year mortgage rate is around 6.5%, keeping monthly payments substantially above pre-pandemic levels. At the same time, high home prices have pushed affordability to difficult levels for many households. Demand has therefore weakened, but prices have remained relatively resilient because housing supply is still constrained in many markets. Nationally, we're seeing slower appreciation rather than the broad price correction many buyers had expected.
Now let's look forward. Our macroeconomic forecasts through June 2027 show mortgage rates at 6.4%, unemployment at 4.4%, and inflation at 2.7%. Together, these indicators suggest that the housing market is likely to remain relatively subdued over the next coming year. Even if mortgage rates gradually decline, affordability won't immediately return to normal. Home prices remain high relative to incomes, and economic uncertainty continues to make consumers cautious about taking on a major financial commitment. The result is a market where transaction volumes may remain relatively low, and home price appreciation is expected to moderate further.
The national outlook hides differences across local housing markets, so let's take a look at that with Vero Forecast. So our latest Vero Forecast shows that Chicago is forecast to appreciate approximately 3% through the next year, June 2027. One of the biggest factors supporting Chicago is limited housing inventory. Unlike many Sunbelt markets, Chicago continues to have significantly fewer homes available relative to historical norms, providing support for prices even as affordability pressures demand.
For Dallas, home prices are expected to remain essentially flat, with the Vero forecast projecting a slight decline through June 2027. Dallas has seen substantial new housing construction and greater inventory availability, giving buyers more choices and increasing competition among sellers. Combined with elevated mortgage rates and affordability pressures, this additional supply is limiting the potential for home price appreciation.
Home prices in Los Angeles are forecast to appreciate just 0.3%, and that's effectively going to remain steady. Here, the major headwind is affordability. Home prices remain exceptionally high relative to household incomes, and elevated mortgage rates further restrict purchasing power. At the same time, supply remains constrained, which prevents weaker demand from translating directly into lower prices.
Miami is also expected to remain flat. Miami is particularly interesting because it is really two markets. Single-family housing remains relatively supply constrained, while the condominium market has considerably more inventory. Miami-Dade had roughly 12 months of condo supply in June, and condominium prices were down year over year, creating greater downward pressure in that segment.
For Phoenix, it's forecast to appreciate at less than 0.5% over the next 12 months. Unlike Chicago or Los Angeles, Phoenix has experienced a greater supply increase particularly from new construction. New listings were up year over year in June. Buyers have more negotiating leverage and asking prices have softened. That additional supply makes Phoenix more sensitive to weaker demand.
San Francisco stands out with a forecast of 2.6%, with a strong probability that the actual outcome will be much higher. Two forces continue to support this market: extremely constrained supply and the concentration of technology and AI-related wealth. San Francisco area active inventory fell sharply year over year in June, while strong technology sector wealth continues to support demand, especially at the upper end of the market.
Finally, Washington, D.C. is forecast to appreciate at 0.5%. The D.C. market faces a unique source of uncertainty: its dependence on federal employment. Concerns about government employment and broader economic uncertainty have weighed on buyer confidence.
So what's the takeaway for Q3? The national housing market is slowing, but it isn't moving uniformly. High mortgage rates and stretched affordability are limiting demand almost everywhere. But inventory, employment, demographics, and local economic conditions determine how those pressures ultimately affect home prices.
Thank you for joining us. I'm Eric Fox, Chief Economist at Veros Real Estate Solutions.
And I'm Reena Agrawal, Senior Research Economist at Veros.